Diversification doesn't mean, hey, I just went and picked two funds, both say large cap on them, and I just wanted to split between these two large cap funds. That's not diversification. What you're probably doing is owning a lot of the same things between those two different funds. You might be taking on more risk than what you need to.
Welcome to the Your Life, Your Money podcast with Scott Sierens, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of the Your Life, Your Money podcast, where we discuss thoughts, strategies, and actions to help you thrive in life, wealth, and retirement. I'm your host, Scott Sierens, also president and financial advisor at Sierens Financial Group. And in today's show, we're going to talk about some year-end 401k tips. And then also stick around to the end. I've got an article that I'm going to go over about how to protect yourself from thieves online. Folks, if you haven't yet, check us out at lifemoneyshow.com. Again, that's lifemoneyshow.com. Again, we've got a lot of content there to help you thrive in life, wealth, and retirement. Now, before I dive into the year-end planning tips, first, I wanted to talk about an article that I was reading, and I'm not sure about you, but I had a lot of conversations over the holiday, right, and had a lot of people that were talking about what they found on YouTube to help them do it themselves, right, a do-it-yourself DIY project, people that were renovating their bathrooms or doing new sorts of crafts or maybe a little bit of plumbing. And they were talking about, hey, if I've got a project I need to get done, I just go to YouTube, look up the video, and get it done. But here's my question for you. Do you feel like you can do it yourself when it comes to estate planning? And I get it, right? We can go to Google, YouTube, and pretty much any project out there, you can do it yourself. But what about when it comes to estate planning, your will, your powers of attorney, your trust? And this first article I just wanted to kind of go over, it was from U.S. News, and the title of the article was Do-It-Yourself Estate Planning Mistakes. Now, I'm not saying that you can't do estate planning yourself. I'm not saying that you can. But what I want you to be aware of is if you do decide to do your estate plan yourself, there's a few things that you might want to think about so that way it gets done properly. And the article goes through here, it's like 3 issues DIY planners, DIY estate planners might run into. And the 3 topics it talks about, number 1 here is you need to know what to ask. Now, if you have a pretty simple estate plan, you have a will, just need powers of attorney, you don't need, there's no sorts of complexity, and you feel like you can follow all of the guidelines that they've written out for you, plus making sure that you get everything filed where you need to get it filed and get it signed by all the appropriate parties, well then maybe everything's okay and then that you can do it, right? But a lot of times it's not knowing what to ask, not knowing what to put in the estate plan, not knowing exactly which documents that you specifically need. So, hey, if things are simple, maybe not a problem. But if you've got a lot of questions that you're going through on your mind, again, then you might sit down, talk to an attorney to make sure that your estate plan, the wills, trusts, all the documents, all the legal documents that you need align with you and your future. Another point that it talks about here is that sometimes your situation might be complicated, right? Maybe you're putting together a more complicated end-of-life plan, or maybe there's some tax complications. Maybe there's detailed flows when it comes to how you want your money to go, right? Meaning either you want certain percentages to go to certain people, maybe you wish to have some funds, I'll call it maybe bypass your children, go to grandchildren. Maybe you have children with special circumstances, or you have children that wouldn't be able to manage these funds on their own, or you felt if your children were to, or your beneficiaries were to receive an inheritance, they would just go and blow it. So you want them to get it over periods of time. And therefore, you might need a more holistic approach where you've got your financial advisor involved, maybe a tax consultant involved, as well as your estate planner involved. So Again, if your situation is more complicated, the cookie cutter list might not cut it for you, and that's where getting the attorney in place, the estate planning attorney in place. One of the things always, right, when it comes down to anything that we have to do in life, right, we have to look at how much time are we going to spend Googling it, researching it, putting together everything, all the different research pieces, versus if you were just to hire an estate planning attorney to get it done for you. So you have to consider that too, right? What are your time trade-offs, and then does it just make it easier for you to go to an attorney because your situation's a little bit more complicated? You're not going to find everything that you need to find on Google or YouTube, right, from what you need to research, and it just makes a little bit more sense to go to that estate planning attorney. And then again, DIY estate planning mistakes. The third thing that the article here talks about, and we'll have a link to it in the show notes, so that way you can go and look at this U.S. News article. But the third point that it talks about is that estate laws vary state to state. So are you familiar with the laws in your state? If you are doing something online, is it specific to your state? Does it give you guidelines, instructions, everything specific to your state? So that way, if you are, doing your will, your powers of attorney, your trust, that you know everything will be taken care of specific to your state. Now, maybe you've got multiple homes, right? You've got homes in different states. Again, things get more complicated. That's when you want to maybe then utilize an estate planning attorney to tackle your overall plan here. So a lot of good points that the article brings up. I realize a lot of times we like to do it ourselves. We like to try to tackle new projects. And as you look at your estate planning, your will, powers of attorney for medical, powers of attorney for financial, these are really important documents, decisions that people will be helping you make someday in your life if you're no longer to make those decisions on your own. So you want to make sure that these documents are properly set up. Like I said before, not saying that you can't do it online, you can't do it yourself. You potentially can. You just have to be aware of some of the different mistakes that you could make. And then also kind of look at it and say, hey, where's the trade-off here? When does it make most sense just to go to somebody who specializes in that, an estate planning attorney, somebody that you can talk to face-to-face or over the phone to make sure all of your issues are addressed. Hopefully, if you're going through that process in your life right now, hopefully it gives you some things to think about and who you may or may not want to talk to, or ways that you may or may not want to proceed. All right, with that, let's move on. Let's talk about our main subject today, and I've got for you 5 year-end 401k tips. I think this is a great time of the year to focus on your 401k. Your 401k is pretty important, right? This might be your largest retirement savings tool. And you can always substitute in the word 403b or 457, for the word 401k. I'm talking about your company-sponsored retirement plan. Really important, right? Times are changing. This is now our bucket of money. This is what we're saving into to help, once again, when those company paychecks are no longer coming in, this will be the money that you have to go to be able to cut your retirement paychecks, your personal paychecks in retirement. So a really important retirement savings tool, and it's important to know that it's on track. So let's talk about some tips, not only for the end of the year, but to also make sure that you're getting yourself on the right track for the beginning of next year. So here we go. Tip number 1 is to max out your 401k. If you have the ability to do so, let's start with this. If you are under the age of 50, the max right now that you can put into your 401k is $19,500. If you are over the age of 50, they allow what they call as the catch-up contributions. So then in total, you can put up to $26,000 into your 401k. Here's the deal, and this is why I say this is a tip that we want to make sure it gets maxed out. And I mean every last dollar that you can get in there. You see, a lot of the companies will limit you on how much you can contribute each paycheck into your 401k because they don't want you to go over these IRS limits, because then there's a lot of corrections that they need to do and forms that would need to be filled out because you went over. So they're always going to limit you and kind of keep you under those amounts. So it's a good time at the end of the year here to just go in, take a look at your 401k, how much you've contributed through the year, and then talk to your company and say, okay, hey, I see that I might be a couple $100 short. How do I make sure that I max out, right, those last few dollars that you can get into the 401k? So you can use your last checks to make sure that you get it all in. Now, maybe you're not able to max out your 401k. So tip number 2 then is to make sure that you're at least getting the employer match, right? So you're not able to max it out. Maybe you're not hitting those 19,500 limits or that 26,000 if you're over the age of 50, but at least get your employer match. That's like free money, right? Because your employer is actually contributing and putting money into your 401k on top of what you're putting in. Now, there's typically a stipulation here, and that stipulation is that you typically need to be making contributions too. So let me give you an example. Just imagine a bucket sitting between you and your employer. And that bucket is called your 401k. Now, if you say, okay, hey, I'm going to put in so much percentage of my check, your employer then has a match, right? So I'm just going to give you an example. All companies are different, so you want to look at your specific plan. But I'm going to give you an example from a recent client 401k I was reviewing. And what their company did is their company gives 100% up to a 3% contribution, and then 50% on the next 2%. So 100% up to 3, 50% on the next 2%. So if you think about that, you add all of those percentages up, right? That means the employee, right? So you as the employee in this specific example, right? Think about that bucket sitting between you. If you as the employee put in 5%, so you're on the one side of the bucket, you contribute 5% of your paycheck. Your employer is on the other side of that bucket. They're going to put in this example, they're going to match that first 3%. So whatever your paycheck is times that 3%, they're going to match that 3% fully. Then on the next 2% you put in, so percentage number 4 and 5, they're going to give you 50% of that. So basically, if you look at it, right, on that next 4 and 5, if we're doing the 5%, they're just going to give you 1 more percent, right? Because they're giving you half of each of those. So they're putting in on one side of the bucket, you're putting in from their company profits on the one side of the bucket, you're putting in from your paycheck on the other side. You want to make sure that you're getting that match. So important. It's money that's, you could kind of call it, I guess, in quotes, free money. And then as long as you stick with your company long enough where the money that they put in becomes 100% vested to you, then when you leave, all of their contributions plus your contributions, you're able to take those with you, leave them there, roll them over, do whatever you so choose. But just to recap, tip number 2, make sure you're getting the company match. It's also a great time to review and make sure that, if you're a little bit short this year on getting the company match, look at your percentages, maybe up your contributions for next year to make certain throughout the whole year, you don't have to wait till the end of the year and do some things at the end of the year, that throughout the whole year, you'll be getting the company match. All right, so getting the company match, that was tip number 2. Number 3, tip here, number 3 when it comes to year-end planning for your 401k, and this is actually a tip maybe for next year, but can you up your contribution percentage? It's a great time to review it. Maybe you just got a raise at the end of the year here, so it's a good time to look at it, look at your raise and say, okay, hey, I'm going to save some more for retirement by upping how much I'm going to put into my 401k, and then maybe keep some for yourself, right? Or just push yourself a little bit harder, because remember, the more you save today, the more you've got compounding for you, the less pressure that you may have then in retirement. So just pushing yourself a little bit harder to say, hey, can I up the contributions I'm making by 1, 2, 3%, maybe even more, but really push yourself to think about how much you're putting in and seeing if you can up that percentage a little bit. All right, tip number 4 when it comes to the 401k is looking at if you have a 401k and if you also have the Roth 401k option, understanding where you're making your contributions to, and then setting yourself up in the right direction for next year. I find a lot of people are just contributing to their 401k, but they might have that Roth 401k option available. That might actually be better for their tax situation. Maybe the 401k is better for your tax situation. So now is a great time to go through that review and then maybe make some changes to where your contributions are going to go to. In my experience, what we do with a lot of our clients is we do an year-end planning review in October. We look for where all of their contributions are going. We look at their lifetime tax projection and then update which tax buckets they're putting their money into. Now, if you need a quick refresher on 401k versus Roth 401k, let's give a high-level summary of that. The 401k, you put money into that today, and when you put money into it, you get a tax deduction today. The money in that 401k bucket grows tax deferred. In the future, the base of what you put in, plus all of the growth that you have in that account, you will have to pay ordinary income tax on all of the withdrawals that you take out of that 401k bucket. Now let's go over the Roth 401k bucket. The Roth 401k bucket, when you put the money into it today, you pay tax today on that money. That money, when you put it into the Roth 401k today, it adds into your overall taxable income. So when you file your taxes, you're going to pay tax on that money today. The difference is this money now grows tax-free. So let's just say you put in $250 and it grows to $500 or $550. I'm going to use that because it'll give us some different numbers here. So you put in $250, over a long period of time it grows to $550, right? So that's a gain of $300. That gain, right, can be withdrawn tax-free. Plus your base of $250 can be withdrawn tax-free, all from the Roth 401k. So that's the biggest difference there. The Roth 401k grows tax-free, and you can make your withdrawals tax-free as well. Which is best for you? Well, that really is understanding your income plan. What does your future taxable income look like? What do you believe taxes will be in the future? Do you feel your taxable income will be higher or lower in the future than where you're at today? Do you feel your overall taxes will be higher or lower in the future? Do you feel tax rates will be higher or lower in the future? We've got a whole lot of content, again, on lifemoneyshow.com. Lifemoneyshow.com, I've got a video there for you in regards to 401k versus Roth 401k, and break it down even further to help you make that decision of which may be best for you. All right, and tip number 5, now is a great time to assess your investment mix. First off, are you invested? Now, I'm going to give you a quick analogy here. Your 401k is like the framework to a car. The 401k is kind of the tax framework. So if you think about your car has a frame to it. The 401k is the tax framework to your account. Now, your car isn't going to go anywhere unless there's an engine in it. When it comes to your 401k, that engine is your investments. And I find that sometimes people are just putting money into their 401k. They're doing a great job savings, but they never gave their car an engine. They never picked an engine, or they picked the wrong engine, right? So take a look at your 401k. Do you have an engine in your 401k? Do you understand the engine, right, that you've picked for your 401k car? Based upon where you're at in life, maybe you want a growth engine. Maybe you want an engine that's kind of got a growth and safety blend to it. Maybe you're more conservative. You need a safer engine. Now, I've always said, and you'll hear this continuously right through our podcast, of how the investment mix should align with your income plan. So I always feel you want to have at least 5 years of income needs on that safer side of your portfolio. If you're not looking to make any withdrawals in the next 5 years, then great. Maybe then you have 100% over on the growth side of your portfolio. Then maybe you're a person that's nearing retirement. Maybe you're 4 years away. So you want to maybe then start to get some money over on that safer side of your portfolio, right? So that way, if we did have a market correction, you've got some funds over on the safer side of your portfolio to help you supplement your income needs if there were to be that market correction. The other thing that I urge you to take a look at is not only just safe versus growth in your portfolio, but a lot of times I get it, the companies can give you this just list of funds. People might go in there and just pick the one with the highest return. But do you also have diversification in your portfolio? What I mean by that is, have you just picked one fund? Have you picked multiple funds? Diversification is, do you have maybe some large caps, some mid caps, some small caps, some international? Diversification doesn't mean, hey, I just went and picked 2 funds that are both say large cap on them, and I just wanted to split between these 2 large cap funds. That's not diversification. What you're probably doing is owning a lot of the same things between those 2 different funds. You might be taking on more risk than what you need to. So if you're not sure or not really sure how to diversify your funds or understand diversification, that's something that I highly recommend that you want to talk to a financial advisor about. The other thing is, I find, if you're really not sure what to do with your 401k, a target date fund could be the right pick for you, meaning you pick a date of the fund based upon when you think you would retire. So let's see, we're in 2021. If you didn't think that you're going to retire for at least another 20 years, you might pick then a 2040 target date fund or a 2045 target date fund. It's just a good way if you're really not sure what to do, then I would kind of urge you more towards those target date funds. However, I do realize that they typically are a little bit more expensive when it comes to the internal fund fees. And as you get closer to retirement, I find that these funds don't necessarily align with what your income plan is, and they could go overly conservative or too aggressive. And so if you're getting closer to retirement, it might be time to shift away from those target date funds into a more diversified portfolio that aligns with your income plan. So there we are, 5 tips, year-end 401k tips. Number 1, max out your 401k. Number 2, make sure you're getting the employer match. 3, up your contribution percentage if you can do it. Number 4, it's a good time to assess the 401k versus the Roth 401k and where your contributions are going. And then number 5 is it's time to assess your investment mix. Make sure your investment mix aligns with your income plan, your future, and the growth that you need. Make sure that you're invested in your 401k as well. All right, I mentioned kind of a closing article, an article I had read in Kiplinger, and I thought this time of the year it would be a really helpful article to just talk about, and then I'll, again, put a link to it in the show notes so that way you can go take a look at the article yourself. But this article is Retirees, it's from Kiplinger, and it's Retirees, Protect Yourself from Thieves Online. And, it says retirees in the subject line here, but boy, this really applies to everyone. Everyone needs to really think about this, and as you're going through the holiday season, as more and more things get purchased online, really look out and make sure that you're protecting yourself. It talked about in 2020, in the first 9 months, there were over 1.3 million cases of online identity theft. They say a big portion of the target are those that are, age 80 plus, are unfortunately far more likely to get scammed. So think about wherever you're at in life. Unfortunately, if you're older, these scammers are going to target you a little bit more. So again, I'll link to the article here, but I thought it gave some pretty good ways that you could protect yourself. One, it talked about how credit cards offer more protection than debit cards, right? And if you think about that, a lot of times if something happens, you can always call your credit card company and say, hey, this was a scam, and then they will take it from there to, chase things down. So think about that. If you're making some online payments, if you're purchasing something from a company that you haven't, don't typically use, maybe use your credit card versus a debit card or versus using, or sending any sort of cash. The second point that they talked about here is don't think that you are immune. I thought this was a good point, right? Because sometimes we can feel like, oh, that never happens to me. I'm not going to be the one that gets scammed. And then next thing you know, boom, that's when it happens. So just constantly be aware as you're filling out forms online, as you're making those purchases on a website. Don't ever feel like you are immune to the scammers. You want to constantly be aware. And it gave us a few good things to be aware of. One is, I'll call it, if you are looking for a deal, the scammers are almost like hunting you down. They're looking for people looking for deals on certain products, or if there's a hot item out there or the product that everybody wants, right? Scammers are really targeting those people because that's where everybody's going. So they're looking for where the volumes of people are going and then targeting those volumes of people. So a few things to look for. You want to look at the URL. Does the URL look like a trusted URL? This was a new one. I'm not sure if you're aware of this, but look at the beginning of the URL. If it says HTTP, but there's no S, then the website's a little bit less secure. So if it's HTTPS, it just means a little bit more secure of a website. Watch for misspellings. If the offer looks too good to be true, well, maybe it potentially is. The other last points here, I will say, I think are really important. First off, credit monitoring services don't prevent identity theft. I've talked to a lot of different folks. They say, hey, I've got, XYZ credit monitoring service. I said, that's great, but have you frozen your credit? They say, well, no, I've got XYZ monitoring, my overall credit. Folks, a credit monitoring service does not prevent identity theft. They help you make you aware of it a lot quicker, but they don't prevent it. So what I recommend, and the article recommends as well, is that you want to do a credit freeze. You call the 3 different credit bureaus. You do a credit freeze. Now, what doing a credit freeze means, it does not mean that wherever your credit is today, it's going to be frozen at that number. It doesn't mean that one bit. But what it means is that nobody can run a credit report on you unless they have your password. And it's a password that they send you in the mail. So it's specific to you. Only you have it. And so, for instance, if you did need a new credit card, if you needed to go for another loan, if you needed to go for whatever it is, anywhere that they need to run your credit report, then you can put in the password, say, hey, unfreeze my credit for this specific company or this specific time period. And then that way, that company that is running the credit report can run it. You get whatever you need. It freezes back up. But you see now, if a scammer got a hold of your social security number and wanted to go start a credit card, they'd try it. The company would go to run the credit report. They'd say, okay, hey, go unlock your credit. The scammer doesn't have the PIN. They're not able to unlock your credit. So again, freezing your credit, I highly recommend this. Trust me, unfortunately, I've been through identity theft. It's a lot of time, a lot of effort to get everything clear off of your name, and just freezing your credit can make that big of a difference, where if they did steal information from you, it just makes it so much tougher for them to go and get loans, start credit cards, do anything with your social security number. Folks, I hope that you found that discussion to be of benefit. Like I said, we'll link to the article in the show notes so you can go read through the article yourself. Make sure you're covered on all the different points, or just how to keep yourself aware from not being subject to a scammer as we go through the holiday season here. I hope you found this podcast to be of value and benefit, and if so, subscribe on your favorite podcast player, give us a rating, and feel free to give us a review. Also, check us out at lifemoneyshow.com, lifemoneyshow.com. All content to help you build wealth and prepare for your financial future. I look forward to our next conversation to continue to help you live life today and be financially confident about your tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.